while live streaming right there. Yeah.
Is that what happened? Because
Yeah.
I completely lost connection. The screen just started doing crazy shit, and then I was gone. I was like,
No,
all right, I blacked
literally,
out. I refreshed.
Literally, it glitched, and there was somebody that was trying to get into my computer. And that's why the whole thing crashed, because that's what it does when somebody's trying to get in.
So basically, it's a safety shut off, shuts everything down when somebody outside tries to.
Correct. Work. Yeah, and then it literally shut down the entire stream just to make sure that nothing was affected computer-wise for that. So I am really, really sorry about that. And I thought I had a funny video, but I'm not going to play that just because I think that
was the end link.
It could have been the end link. So that's not what it was supposed to be. It was supposed to be Baby Trump and Baby Trump talking to a bunch of baby police reporters and from the New York Times. And it was funny, but the reason why I'm picking our government / Trump is because I've been fed way too much bullshit over the last 6 years. I honestly, I've been fed way too much bullshit. From top to bottom, left to right, I don't care what politician you are, you've just been doing nothing but feeding me shit. And nothing that does to actually better us as people. Giving a direction, understanding where we're going. I mean, honestly, you have a meeting with all the banks. A private meeting. What is that for? And leaks come out and say, is to help protect the banks for the immediate crash that's about to happen. What?
It wasn't even just that. The timing of it was right before the fucking stress test reports.
Correct.
Which then they rebalanced the fucking stress test stress windows, values.
Yeah, the actual values, so that it actually makes sense. And they don't. They still don't make sense. Because as I went over, I mean, the 10Ks, your 10Ks, for the most part, when you are filing them, they're supposed to make sense. That's exactly what's going into the SEC. That's the reference they're going off of. But that does explain a little bit of what's going on behind the curtain for any company, for the most part. But what is being put onto the actual books is all lies. And there's no valid reason. None. You can't.
Well, I mean, there's a reason, just not a valid one.
The valid reason is what the validity, but there's no reason for it. None. This should have been over. The banks should have been done. There's no reason to protect them because it goes into two things. It was the same thing they didn't want to happen while Biden was in office. They didn't want it to crash under Biden. Because then it would just, kill the Democratic Party. Plain and simple. Now Trump's doing the exact same thing. It wouldn't be surprising to me if someone got into that office. It wouldn't. Here's Iran. Iran keeps on happening. Where's the ceasefire? Oh, we had a ceasefire in Lebanon. No, we didn't. They're still shooting. What has changed? I really want to just be, I don't care how bad it is. I really don't. Do you really think that anybody could have just came in here and fixed the issues that we currently have right now? No. Do I believe, and Matt, I'm like with you. Do I believe that Trump could have done something? Absolutely. If he was given the full arsenal that he needed to do it. But he wasn't given that. He was hamstrung from the beginning.
Not only was he hamstrung, but they did everything in the Biden administration to make things so ridiculously bad that, I had my doubts if even he could do it.
Correct. But that's what I'm talking about. But Oh, hey, we're supposed to help retail. Oh, hey, we're supposed to fix this. Oh, hey, we're supposed to fix the stock market. Oh, hey, we're supposed to do this. None of it has happened. Not one thing.
A lot of lip service and then opposite.
Correct. And it's getting really, really tiresome to basically go ahead and, have faith in a system where you are expecting change. You're expecting a difference. You're expecting something to actually happen, and it doesn't. And then some of the behind the scenes mechanics that are going on from a government perspective are just wild. I mean, wild. And why I say wild, because if you guys don't think that this is going to be wild, holy Jesus. Which leads us into what we're going to be talking about tonight.
Before you move on, I got to do this.
Go ahead.
Biggest dum-dum, the biggest you ever seen. You never seen a big dumb like this before.
I can't wait.
First. Biggest dum-dum ever.
You can't wait. Can't wait.
You won't believe how big a dum-dum.
I can't wait. What is it? You can't get me all.
No, I'm doing the Trump impression about the big dum-dum.
Oh,
the biggest ever. Biggest dum-dum ever.
Oh my God.
Dum-dum like you've never seen before.
Oh my God. I mean, it's honestly maddening, but what we're about to go over, and Matt, you did a lot of help on this one, especially because...
Oh wait, I got to defend myself a little bit. I did not initiate this fucking overnight fucking 24-hour fucking job. He initiated this. I just fed into what he was trying to go and helped him with direction.
Yes. Well, here was my original direction, just so everybody understood. I was really trying to find the actual swap positions and legacy short positions of AMC with Credit Suisse. Is the direction that I was going in. And I kept on getting close, and then I got the door slammed shut on me. And I kept on getting close, and then I got the door slammed shut on me. And so on and so forth. And I didn't have a way around. And then all of a sudden, Matt and his genius helped me find something that's just as good. If not, in my opinion, actually better. Because this pertains to the whole market wide and how they do this. And how
what I did is I directed them into the risk exposure reports and then the insurance that's backing the derivative exposure.
Correct.
Because when you think of 2008-9 crash, if you really wanted to know the size of the derivative bubble, all you had to do is look at the size of the insurance obligations that were held under AIG.
Mm-hmm.
So instead of trying to find the derivative total, I had them look up the insurance hedge against the derivative risk exposure.
And this is where you guys are going to learn something that they've never wanted you to learn. Ever. The illusion of stability. How private credit, derivatives, and liquidity are holding together a system that pretends it isn't held together. Let's start with the version you're supposed to believe. The version where everything is working exactly as intended. The version where the experts nod confidently on TV. The numbers look big and impressive. And the words resilient, well capitalized, and stable get repeated enough times that eventually people stop asking questions. So here it is, nice and clean. The system is not collapsing tomorrow. The system is not transparent. The system is not nearly as stable as it pretends to be. Now that we've cleared the marketing brochure out of the way, let's talk about what's actually sitting underneath it. What you are looking at, whether you realize it or not, is a financial system built on four things: debt, derivatives, confidence, and constant intervention. And no, that's not an exaggeration. That's the structure. Start with the easy one: debt. The United States alone is dealing with trillions in rolling obligations every year. Not because something went wrong, but because that's how the system is designed to function. Debt isn't paid off, it's refinanced, extended, and expanded. According to the data of the U.S. Department of Treasury, trillions in Treasury securities matured annually and are replaced with new issuance. That's not a crisis event, that's Tuesday. The catch: it only works as long as someone is willing to keep buying the debt at a price that doesn't break the system. So now layer on derivatives. The part nobody explains at dinner because it kills the mood. Globally, derivatives markets run into the hundreds of trillions in notional value, according to the Bank of International Settlements. The number sounds insane because it is. But here's the trick: the system tells you not to worry because the net exposure is much smaller. And that's true until it isn't. Because all of that netting depends on the counterparties doing exactly what they're supposed to do, exactly when they're supposed to do it, in conditions that are, let's be honest, never ideal when things actually go wrong. Then comes the most fragile piece of all: confidence. Not capital, not collateral, confidence. Confidence that markets will stay liquid, counterparties will pay, assets will hold value, and nobody will rush for the exits at the same time. Because if they do, that's when the math stops working and the psychology takes over. And markets, for all the sophistication, are still driven by humans' behavior when pressure hits, which brings us to the final pillar, holding this whole thing together: constant intervention. This is where the quiet part becomes loud, if you're paying attention. When markets seize up and liquidity disappears, when funding stress creeps in, there is one entity that steps in every single time, and that's the Federal Reserve. Not because it wants to, because it has to. We saw it in 2008, we saw it in 2019 repo spike, and we saw it again during the 2020 market panic. And the system was quietly patched again. And each time, the message was the same: this is temporary, this is contained, this is under control. And each time, what actually happened was liquidity was injected, markets were stabilized, and the system was quietly patched again. So no, the system is not collapsing tomorrow, but that's not the right question. The right question is, how much effort does it take to keep from collapsing? Because that effort is increasing. Debt is more expensive than it was just a few years ago. Liquidity is more selective. Risk is harder to price. And margin for error, it's getting thinner. Even regulators are starting to say the quiet part out loud. The Federal Deposit Insurance Corporation noted in 2026 that rapid deposit outflows and market stress can exceed the assumptions built into liquidity rules, meaning that in a true stress event, private markets may not be enough, and central bank support becomes the only viable option at scale. Translation without the polished language: the system works until it needs help. And when it needs help, it needs it fast. Now, here's where this starts to matter to you, the person reading this, not the institution reporting it, because none of this shows up clearly on the surface. What you see is stable markets, functioning banks, normal headlines. What you don't see is how dependent those conditions are on continuous stability, how interconnected the risks actually are, how quickly things can shift when one part of the system stops cooperating. And that's the part that should make you pause. Not panic, just pause. Because the system isn't fake. It's not some grand illusion. Watching to disappear overnight. It's something much more complicated and honestly much more uncomfortable. A system that is real, functional, and incredibly efficient as long as the conditions it depends on keeps holding together. And right now, those conditions are getting tighter, more expensive, and less forgiving, which brings us to the next part of this report, where we stop talking about structure and start talking about what happens when structural actually gets tested. Private credit, safe yield, trust me, bro, until the music stops and nobody can find the exit. Let's talk about the part of the financial system that quietly ballooned into a multi-trillion-dollar beast while everyone was distracted arguing about interest rates, inflation, and whatever headline was trending that week. Private credit. You probably heard of it. Dressed up in language that sounds clean, controlled, and almost comforting. Alternative lending, direct financing, stable yields in a volatile world. It sounds like something finally figured out how to make money without the chaos. Like this is the evolved version of finance where everything just works. But here's the part they don't say out loud. Private credit is now sitting at roughly $3.5 trillion globally, according to estimates tied to institutions like the International Monetary Fund, which means this isn't some niche corner of the market anymore. It's big. It's everywhere. It's large enough that when something goes wrong, it doesn't stay contained. And here's where things start getting uncomfortable. Most of the market doesn't trade daily, isn't priced in real time, and isn't valued based on what someone would actually pay for it in the open market today. Instead, what you get is a number, a very confident number, the kind of number that shows up in reports and presentations and makes everyone feels like everything's under control, mostly because it hasn't been tested yet. That number is built on assumption, like this borrower will refinance just fine. Default risk is manageable, and market conditions will stay cooperative, which sounds reasonable right up until those assumptions get challenged. What you don't get is the price in a stressed market, the discount required to unload that asset quickly, or the version of the number that shows up when buyers suddenly disappear. Because that number, the real one, only appears when someone actually tries to sell. And here's the uncomfortable truth. Nobody is in a rush to find out what that number really is. So when you hear people start talking about, 60% markdown scenarios, they're not saying the system has already collapsed. They're pointing at something far more subtle and far more dangerous. They're saying that if these assets had to be priced honestly, under pressure, in a real market, with real buyers and real fear, the gap between what we say that's their worth and what they're actually selling for could be a very large, not dramatic, not a conspiratorial, just untested reality. And we don't have to guess how that plays out because we've already seen the blueprint. Look at Evergrande and Country Garden. These weren't just isolated failures or a couple of bad decisions. They were entire business models built on leverage, refinancing, and the assumption that funding would always be available when needed. And for a while, the assumption held up till it didn't. When those systems broke, it wasn't because of some dramatic single event. It was because debt kept building. Refinancing became more expensive and less certain. Cash flow couldn't keep up. And eventually, the math stopped working. The spreadsheets looked perfect right up until reality showed up and exposed what they were really built on. Now, take that exact dynamic and scale. Let's scale it across a 3.5 trillion global market. And you start to see the same pressure points forming in real time. Default rates are creeping higher, with some segments pushing into the 9% range or more. Borrowing costs have jumped from near zero levels to something much closer to 6 to 10%, which completely changes the economics for borrowers, and investors are starting to ask questions that didn't exist a few years ago. On top of that, you've got a new risk entering the system, like AI disruption, affecting the actual business model of the companies behind these loans, because apparently this structure model of the company, or this structure, needed one more wildcard variable thrown into it. So now you've got borrowers who may not grow the way projections assumed, may not refinance on the same favorable terms, and may not generate the cash flow that those very confident numbers, quote unquote, were built on. And suddenly, that steady, predictable yield doesn't look so steady anymore. It starts to look like risk that hasn't been fully priced.
And add to that, they're currently valuated at 30 times revenue. So when you reevaluate, you also reevaluate the per earnings multiplier.
So you're buried. I mean, you're buried. And here's the part that makes the whole system deceptively stable. It doesn't break all at once. It doesn't panic. Doesn't flash warning signs. And it definitely doesn't announce that something is wrong. Instead, it adjusts quietly. Funds start tightening withdrawal terms, extending liquidity windows, and adding layers of fine print that nobody pays attention to until they need their money back. Lenders begin demanding better collateral, raising rates, and become more selective about who gets financed. Investors start shifting capital, hesitating just a little longer, and watching exit opportunities more closely. On the surface, everything still looks fine because nothing has actually snapped, but underneath, the behavior has changed, and that's the real signal. Systems like this don't collapse the moment everyone realizes there's a problem. They start to crack when enough participants begin acting like there might be one. That shifts in behavior creates pressure, and that pressure doesn't need a full-scale collapse to matter. All it takes is a slightly higher default, slightly tighter liquidity, and a slightly lower valuation across a system that's this large to start creating real consequences. And the most important part, the part that should actually hold your attention, is that this isn't isolated. Private credit is deeply connected to the rest of the financial system. It ties into banks through financing and exposure. It insures through investments, portfolios, and into derivatives markets through hedging and structural products. So when stress starts building here, it doesn't stay nearly contained in one corner. It moves, not all at once, not dramatically, but steadily, quietly, and often before most people even realize it's happening. Which brings us to the question that really matters, and the one nobody is eager to answer. What happens when the very confident numbers finally have to meet a real market? The fully hedged fairy tale. Or how everyone became the insurance company nobody remembered signing up to.
Is huge. This is unbelievable, unfathomable.
Yeah, you guys are gonna be pissed. Just so you know. Get ready to have your angry face on, because this is the part where I've been trying to figure this out forever. Honestly, forever. Because 2008 is the best reference for us to actually kind of utilize when it comes to a crash of this magnitude. This doesn't even compare. I mean, this is wow. Just you wait. Let's talk about one of the most comforting phrases ever invented by finance. Don't worry, it's hedged. Don't worry, it's insured. Those two sentences have probably prevented more panic than actual risk management ever has. They sound responsible, professional, reassuring, like somewhere behind all the complexity, there's a safety net quietly waiting to catch everything if it falls apart. There isn't. There is no giant vault somewhere labeled derivative insurance fund with trillions sitting inside it just waiting to step in when things go wrong. There is no master policy that says, if this all blows up, we've got you covered. What actually exists is something far more fragile and far more dependent on everything working exactly as planned. The global derivative market, according to the Bank of International Settlement, runs into the hundreds of trillions in notional value. Now, before anyone panics, the industry will immediately tell you, don't worry, that's not the real exposure. And they're right, technically. After netting and collateral, the real exposure is much smaller, but here's the catch. That reduction only works as long as the system behaves perfectly. And systems, especially ones built on leverage and trust, have a habit of behaving perfectly, right up until they don't. So if there's no insurance pool, what actually is holding this thing together? I'm glad you asked. First, you got collateral, which is the closest thing to this system has to real protection. Banks like JP Morgan Chase and Bank of America report hundreds of billions of dollars in collateral held and posted against derivative exposure. This is the day-to-day shock absorber. Prices move, collateral gets adjusted, everyone stays balanced. It works beautifully in normal conditions. But here's the part they don't emphasize. Collateral only protects you as long as markets are stable enough for that collateral to hold its value and for margin calls to be met on time. When volatility spikes and asset prices start dropping fast, that protection can sink at the exact moment you need it most.
I want to add to that real quick so people understand.
Mm-hmm.
The very hedge, the AIG, the insurance value, the margin risk that is the insurance for the derivatives are the same asset underlying collateral that's in the derivatives.
Hmm. Oh, I'm going to get it. Don't worry. We're going to explain that one here a little bit better here shortly so everybody understands what Matt just said. Then you have netting, which is where things start to feel a little magical. Through legal agreements, mostly standardized under ISDA contracts, institutions offset positions against each other. So instead of owing 50 trillion, they owe something closer to 100 billion after everything is netted out. Sounds incredible, efficient, almost elegant. And it's on paper. Because netting assumes that all counterparties remain solvent and that all agreements hold up under stress. In other words, it works perfectly as long as nobody important fails. The moment one large participant can't meet obligations, those neat little offsets don't disappear, but they do get a lot harder to rely on. And suddenly that small net exposure doesn't feel so small anymore. And finally, we get to the part that everyone loves to call insurance: credit default swaps, or CDSs. These are the instruments that are supposed to protect against defaults. If something goes bad, the CDS pays out. Problem solved, right? Well, not exactly. Because a CDS is an insurance in the traditional sense. It's a contract where somebody else agrees to take the loss, not a centralized insurer, not a guaranteed pool, just another counterparty on the other side of the trade, which means
collecting a premium for that value.
Yeah, which means that the entire system quietly depends on that counterparty being able to pay when things go wrong. And if multiple things go wrong at once, you don't just have one claim, you have a chain reaction of obligations all hitting at the same time. Which brings us to the question everyone should be asking, but almost nobody does. Who's actually on the hook? Back in 2008, the answer was easy. It was, Matt, AIG.
AIG. Goldman Sachs literally sold dirt junk bonds when they realized what they were, while maintaining the AIG insurance on the bonds that they sold, knowing that they were going to fucking falter. And they made a shit ton of money on the AIG credit default swap insurance for them, for them
Your
tranches
CDSs.
that they sold no longer even owned.
So one company took on massive amounts of risk through credit default swaps, collected premiums like everything was fine. And then when the system turned, couldn't pay. The result, a bailout, because letting that single point of failure collapse would have taken the system down with it. So we fixed it, right? Not exactly. What we did instead was something far more subtle and arguably more complicated. We didn't eliminate the risk. We didn't remove the need for protection. We didn't even reduce the overall exposure in a meaningful way. We distributed it. Today, there are no single AIGs. Instead, the role is spread across JP Morgan Chase, Goldman Sachs, UBS, hedge funds, insurers, private credit funds.
When you say insurers, and I want people to understand this too, the biggest contributor to the private credit insurance back investment pool is the life insurers.
Correct.
And they're so fucking upside down in the liquidity pool that if basically need to borrow money to pay out life insurance.
Correct.
Because until they can liquidate whatever term they have on their private credit investment.
Each of them hold a piece to the puzzle. Each of them writes protection, hedges risk, finances positions, or sits somewhere in the chain. And on paper, that sounds safer, diversified, more resilient, less dependent on a single point of failure. But here's the uncomfortable truth. We didn't remove the bomb. We just broke it into pieces and handed it onto everyone. Now, instead of one institution falling spectacularly, the risk is that multiple participants start struggling at the same time. Not enough to trigger immediate collapse, but enough to create stress, enough to tighten liquidity, enough to make everyone a little less willing to extend credit, a little more caution about exposure, and a lot more focused on protecting their own balance sheet. And that's where the real danger lies. Because this system doesn't break when one entity fails. It starts to break when too many entities need cash, collateral, and confidence at the same time. That's when derivatives stop looking like protection and start looking like interconnected obligations. That's when hedged starts meaning we hope the other side can pay. That's when the illusion of insurance fades. And what's left is a network of promises that all depend on each other holding up under pressure. And if you've been following everything up to this point, you can probably see where this is going. Because now we're not just talking about risk. We're talking about what happens when that risk actually gets tested. The domino effect. How plenty of liquidity turns into good luck getting your money back. Hence, fake liquidity. And fake liquidity. And fake liquidity. And fake liquidity. So let's walk through what actually happens when this beautiful, engineered, highly sophisticated, confidence-driven system stops behaving the way it's supposed to. Not in economics language, not in central bank press release language, just normal reality. Because when things break, they don't break in spreadsheets, they break in sequence. And the sequence matters more than anyone else. It starts quietly. It always does. Private credit. Remember that stable yield machine? Everyone loved taking a hit. Maybe it's higher defaults. Maybe it's refinancing dries up. Maybe those borrowers that were supposed to grow into their debt suddenly don't. Loans get marked down. Not aggressively at first, just enough to raise eyebrows. Funds start taking losses. Nothing catastrophic, yet just uncomfortable. And then the first real signal shows up. Investors want out. Not all of them, not at once, just enough to matter. Redemptions begin. And here's where the first illusion where did I lose my spot now? It's always fun when that happens.
That's where the illusion.
Yeah, I know that, but it always happens. Redemption begins. The illusion cracks because those assets, they're not sitting in a liquid market waiting to be sold. They're locked in deals, contract structures. So instead of smoothly returning capital, funds start doing what they always do in these moments. They slow things down. Withdrawals get limited. Liquidity gates appear. Redemptions windows stretch. It's not a freeze. It's just managed expectations, which is the very polite way of saying you can't get your money when you thought you could. That's the first domino. That's where we are now. Now, things start spreading. Because while funds are trying to manage withdrawals, the derivative side of the system, the part where that was supposed to hedge all this risk, starts waking up. Volatility increases, price move faster. And those nice, clean hedges, well, they come with the catch, margin. Suddenly, margin calls start going out, not because anything catastrophic happened, but because things are moving just enough to trigger them. And here's the fun part. Everyone needs cash at the same time, not next week, not next quarter, now. Hedging, which sounded like protection when markets were calm, starts feeling a lot more like a bill that just showed up all at once. Liquidity that seemed abundant suddenly has a price, and it's rising fast. Now step back and think about what that means. Funds are trying to hold on to cash because investors want out. At the same time, derivative desks are demanding more cash because positions are moving. So the system does what it always does under pressure. It starts selling what it can. Not necessarily what it wants to sell, but what it can sell. And that's where things begin to tighten across the board. Next up, insurers. The quiet giants in the background. The one holding long-term assets, collecting premiums, and assuming everything will play out over time. Except now, asset values are dropping. And unlike markets, liabilities don't drop. Insurance obligations don't suddenly become optional just because markets are stressed. So now you got a mismatch. Assets under pressure, liabilities unchanged. That creates capital strain, not an immediate collapse, but enough to make them more cautious, enough to make them pull back, enough to make the system just a little tighter than it was before. And then we get to the part where everyone suddenly pays attention. Banks. Banks don't need to fail to cause problems. They just need to change behavior. And when they see rising risk, tighter liquidity, and stressed counterparties, they do exactly what you expect. They pull back. Credit tightens, lending slows, balance sheets shrink, risk tolerance drops. And just like that, the system that was flowing smoothly starts to feel friction. Not because money disappeared, but because nobody is eager to be the one holding the risk when things get worse. And this is where the word everyone loves, liquidity, finally gets exposed for what it actually is. You've heard it 1,000 times. There's plenty of liquidity in the system. Of course there is, until there isn't. Because liquidity isn't some permanent resource sitting in a vault. It's not a number printed on a report. It's not something that exists independently or behavior. Liquidity is the one thing, the willingness of someone else to take your trade. That's it. That's the whole definition. And when stress hits, that's willingness disappears faster than anyone else in finance. Spreads widen, buyers step in. Prices gap lower, not gradually, but suddenly. And the same asset that were liquid yesterday becomes something very different today. Something you can't technically sell. Just not at a price you're going to like. And that's when liquid markets quietly turns into good luck finding a buyer.
And now I got a perfect example for this, and I want to add to it.
Go ahead.
The movie Margin Call,
Mm-hmm.
when they did the fire sale,
Mm-hmm.
he had to get approval and talk to his boss, and his boss said 65 cents on the dollar, sell it. That's a 30%. Yeah, sell it. I don't care. Gone. Went from what? In 2 hours, went from 94 cents on the dollar, 93 cents on the dollar to 60 in one trade.
That's crazy.
Now, imagine that firm doing that fire sale was also the seller of credit default swaps to the very entity that they just sold at the 93 cent on the dollar when it just got realized on a sale at 65 cents on the dollar, lost 30% of its value. And now that credit default swap that you're insuring kicks in to the person that you just previously sold at 93 cents on the dollar, and they want their credit default swap insurance claim
Good
as
luck.
the hedge against the loss on that value that they just ate 30%
Good
and out.
luck. Good luck. That's gone.
Now, by the end of that so-called fire sale and margin call, you got all these claims coming in. So yeah, you survived because you were the first out and you made all that bang on the front end. And yeah, you ate some losses, but you survived. But what'd you survive left with? Did you survive with enough left to cover all the credit default swaps that you've been collecting premium on as the quote unquote AIG insurer of your counterparties? Or are you now bankrupt too? And if you are bankrupt and you can't insure the counterparties and their insurance, the next bank, and the next bank is insurer of the next bank on the very same collateral credit default swap entities that are absolutely crushing liquidity in the market with no out and prices just falling.
Mm-hmm.
Where's the insurer? You don't have one AIG entity that you can just bail out that one thing and save the whole system. Every single fucking leg in the system fails.
So now at this point, the system has a choice. Let's play out or step in. And this is where the final piece enters. Right on schedule, the Federal Reserve. Because when funds are strained, derivatives are demanding cash, insurers are tightening, and banks are pulling back, there's only one entity left that can inject liquidity at scale instantly without asking whether it makes economic sense. Repo facilities open, liquidity gets injected, emergency tools get dusted off, and the system stabilized not because the underlying problem disappeared, but because something bigger stepped in to absorb the pressure. Which brings us to the uncomfortable truth most people never hear clearly. The system doesn't break because one thing goes wrong. It breaks because multiple things demand liquidity at the same time. And when that happens, you find out very quickly that liquidity isn't infinite. Hedges aren't perfect, and fully insured was never really what it sounded like. And if you've been following this chain carefully, you can probably feel where this is heading next, because once the system starts needing support, it keeps functioning normally. The question is no longer whether it works. The question becomes, how long can it keep working like this?
Yeah, because I'll add to that too. Netting goes out the window when liquidity dries up, and all of a sudden now you're exposed to the entire notional.
Which is why the AI will save us trade, or how we put the entire market on a handful of stocks and called it diversified. Buy the dip. Let's talk about the part of the system everyone thinks they understand but doesn't fully appreciate until it moves against them. Equities, and more specifically the S&P 500. If you've listened to the headlines, the story sounds incredible. Markets are strong, innovation is booming, AI is transforming everything, and the future looks like it's being built in real time. And to be fair, some of that is true. But here's the part that doesn't get explained clearly enough. The market isn't rising evenly. It's being carried by relatively small groups of mega cap AI driven tech heavy companies that are doing most of the heavy lifting. Now let's keep this honest. No, the S&P 500 is not literally 60% tech. According to the S&P Dow Jones indices, information technology makes up roughly around 30 to 35% of the index. But when you layer in communication services and parts of consumer directional or discretionaries where many of these AI driven giants actually live, you start to see the market that is heavily tilted towards the same narrow growth narrative. So, no, it's not technically 60, but functionally, it's concentrated enough that when those names move, the entire market moves with them. And that's where things start to get uncomfortable because what looks like diversification on paper starts behaving like concentration in reality. Now, here's why that matters in plain terms. If those AI and megacaps names keep going up, everything looks great, portfolios grow, retirement accounts recover, confidence stays high, and nobody questions the structure. But if those same names start falling hard, the effects isn't isolated. It spreads quickly because those companies don't just represent stock prices, they represent household wealth, institutional portfolios, and most importantly, collateral. And when prices drop, the collateral shrinks, borrowing power tightens, risk tolerance disappears faster than anyone expects. Suddenly, what looks like a strong, resilient market starts acting fragile, not because it was fake, but because it was dependent on a small group of assets continuing to perform. And here's the part most people miss entirely. The pressure doesn't stay inside the stock market. It leaks into everything else we've already talked about: private credit, lending conditions, broader financial stability, because many of the same companies and sectors driving equity valuations are tied directly or indirectly into financing structures, debt issuance, and investor flows. So when these valuations come under pressure, you don't just get a bad week in the market, you get a tighter credit, lower valuations across related assets, and sudden shifts in how risk is priced across the system. And that's where everything we've just walked through stops being theory and starts becoming something a lot more real. Because this isn't just about private credit or derivatives or equities or even liquidity on their own. It's about how all of them connect, how they reinforce each other, and depend on the same fragile set of assumptions holding together at the exact same time. You've got a system where asset prices support collateral, collateral supports borrowing, borrowing supports liquidity, and liquidity supports confidence, and confidence, more than anything else, is what keeps the entire structure standing. As long as that loop holds, everything looks stable, everything feels manageable, and the narrative stays intact. But the moment that loop starts to weaken, even slightly, you don't get a clean break. You get pressure building across every layer at once. Equities weaken, tightens collateral. Collateral stresses pressures across every layer at once. Equity weakens, credit stresses spills into derivatives. Derivatives demand liquidity, and suddenly the one thing the entire system depends on, constant, reliable liquidity, becomes one thing everyone is competing for at the same time. And that's the part that should actually make you stop and think. Not panic, just think. Because none of this requires a dramatic collapse to matter. It doesn't require headlines screaming crisis. It just requires enough stress in enough places at the same time to expose how dependent everything is on everything else working perfectly. And when you expose how dependent everything is on everything else working perfectly, just step back and look honestly. That's the real story here. That the system is broke. That the system is broken, but that is far more dependent, far more interconnected, and far more sensitive to pressure than most people are ever told. And this is where the real issue shows up. That the one nobody is eager to say out loud. The entire system runs on assumptions, not guarantees. The debt can always be rolled. The collateral will hold value. That counterparties will pay. And that liquidity will be there when needed. And as some of those assumptions hold, everything works beautifully. But the problem is those assumptions aren't tested when things are going well. They're tested when things go wrong. And when they start to fail, they don't fail at one at a time. They fail together. Debt becomes harder to roll. Collateral loses value faster than expected. Counterparties become less reliable. Liquidity begins to disappear at exactly the moment everyone needs it most. And that's when the system stops feeling smooth and starts feeling fragile. Not because it was fake, but because it was built on conditions that all needed to hold at the same time. And right now, if you step back and actually look at the bigger picture, you can see the pressure building from multiple directions at once. You've got concentrated equities, exposure tied to narrow group of companies, rising borrowing costs across the board, visible stress building in private credit, and an incredibly reliance on liquidity support just to keep everything functioning normally. None of these things on their own break the system, but together they tighten it. They reduce the margin for error. They make everything less forgiving, which leads us to the only question that really matters. Now, the one sitting underneath everything, whether anyone wants to admit it or not. What happens when the system stops being able to rely on the very conditions it was built on? Which leads to my final word. And where I'm going to explain this masterpiece of dog shit wrapped in cat shit. Because if this hasn't made you mad, I don't know what else will. To be honest with you. And if you didn't get it, you should read it again. Because a lot of this is exactly what you guys are playing into right now. This is the entire game. This is the entire game that we're sitting on. This is the entire game that we're playing. They didn't want us to figure this out. We did. Now it's time for you to play the game. And play the game our way. Not their way, our way. My final word. This is the game they didn't explain to you. Let's stop pretending this is about confidence, market dynamics, or whatever polished phrase gets rolled out to make everything sound under control, because it's not. What we just walked through, private credit, derivatives, liquidity, equities, that's not theory. That's the structure. That's the system you are trading inside of. And it's built in a way most people are never meant to fully see, let alone understand. This is the system that hides risk behind complexity, spreads liability so thin that nobody looks responsible, and then relies on constant intervention to keep the whole thing standing. And after all of that, it turns around and tells you, don't worry, it's under control. That's the part that should actually piss you off. You're told the system's safe. You're told that the risk is managed. You're told everything is transparent enough. But in reality, you can't see the full exposure. You can't see the counterparty chains. You definitely can't see where the loss actually lands when things go wrong. Banks, hedge funds, family offices operate in levels. They hedge, they offset, they move risk, they structure deals to so exposure isn't obvious. And they eliminate risk. They reposition it. They shift it. They distribute it. And when things go wrong, they're not asking how to protect anyone or everyone. They're asking where the loss lands and how to make sure it's not on them. That's the game. And if you're a retail trader stepping into this without understanding that, you're not just trading. You're walking into a system where the rules are written by people who see more than you do. But here's where this shifts. And this is why I do this. I'm not here for followers. I'm not here for clicks. I'm not here to be some hero people point to when things go bad. I'm here for one reason. I want you, retail, to understand what they're actually up to, what you're up against, so they can't win. Because I believe something simple but powerful. A smart investor is the best investor. Not the fastest, not the loudest, not the one chasing every move. The smart one. And here's why that matters. Smart investors understand the system before they trust it. They don't just look at the price. They look at structure. They don't just react to headlines. They question what's driving them. They don't assume liquidity will always be there. They recognize when it's real and when it's just a byproduct of calm conditions. They understand that hedges doesn't mean safe, that diversified doesn't always mean protected, and that when pressure hits, the rules of the game can shift very quickly. That kind of understanding doesn't make you perfect, but it makes you prepared. And in a system like this, prepared beats lucky every time. Because once you understand how the system really works, not the surface version, but what's underneath it, changes how you see everything. You stop reacting emotionally. You stop chasing narratives. You start asking better questions. You start seeing pressure before it becomes panic. You start recognizing patterns before they come headlines. And that's where the edge is. Not in guessing the next stock. Not in following the loudest voice. But in understanding the system that you're trading inside of better than the people who are blindly trusting it. And this is especially for the communities that get dismissed, mocked, or underestimated, the so-called meme investors, because what most people don't realize is that those communities are paying attention in ways traditional finance didn't expect. They're asking questions they weren't supposed to ask. They're looking at structures the way they weren't supposed to question, and that matters. Because the more people understand how the system actually works, the harder it becomes to hide behind complexity and call it stability. Now, let's be clear about something. The system isn't built to fail fast. It's built to fail slowly, while telling you everything is working perfectly. It absorbs stress, it redistributes pressure, it delays consequences, and as long as it keeps doing that, it survives. But survival doesn't mean it's healthy. It just means it hasn't been forced to face reality all at once. And when that moment comes, and it always does, just in different forms, The institutions that built this system, benefited from it, and defended it, suddenly need to be saved by it again. So yeah, you got everything right. You got every right to be angry. Not because the system exists, but because you expected to participate in it without being shown how it actually works. And that's not something you fix by walking away. That's something you fix by understanding it better than the people who assumed you won't. Because at the end of the day, this isn't about them. It's about you. It's about whether you walk into a system blind or informed. Whether you play the game or actually learn how the game is played. And most importantly, whether you stay a passenger in this system or become someone who can actually navigate it. Because I don't need the credit for this. I don't need the recognition. All I care about is that the people paying attention, the ones in these communities, the ones asking the questions, and the ones trying to understand, stop making decisions that put them in a position to win. Not someday, not if things go right, but because they actually understand what's happening behind the curtain. Matt, as always, thank you for joining me on this. I hope
This is probably one of the more important spaces that we've done recent when it comes to where the liability falls, because if it falls on every one of them, every one of the institutions is its own back crutch for the next.
Hey, at least, like I said, it's the waterfall effect. If one person helps the other one that's failing.
Because at least with 2009, you could point at AIG and say, okay, the rest that survived are going to require bail-ins, and AIG is going to require a bail-in in order to forward the credit default swap insurance against the losses on certain aspects of these other central banks.
It was one entity, not all of them.
Right? Yeah, now it's just
one supports the other, one supports the other, one supports the other until they all fail.
But not one of them will survive this. So there isn't even going to be a strong one. What did we discuss? Which bank was it that had, you said Citibank.
Mm-hmm.
Citibank had to buy
a shit ton of JP Morgan.
A shit ton of JP Morgan.
Mm-hmm.
And that was in part to save part of the bailout process value.
Correct.
Right. And that scenario is not possible here.
No.
Because they're all fucked. Ain't nobody going to have assets to take on any of that. Every fucking thing, every loss is going to be compounded through every institution. And every institution's going to need, the backstop.
Do you know what this sets up for? It's
going to be 100% bail-in.
I can tell you what. I can tell you what this sets up perfectly for.
There's no more manure field left to spread manure on.
This is how this.
You've actually manured the shit out of the entire field, and everything's dying.
This is how this sets up perfectly for every single bank is on fire besides the three that the government can protect. And the ones that the government will protect are probably the ones that have the most amount of dirt on the government that you'll be forced to bank at. That's what it sets up for. It really does.
When you take that into consideration,
mm-hmm.
and you look back on the Credit Suisse default and how close that came to an absolute catastrophe.
Mm-hmm. Makes sense.
And the fact that UBS was still in all kinds of balance trouble, just even with the 20 billion, which turned into 27 billion after they moved to US and got US money involved.
Yeah.
Right. and we're still in fucking trouble, and they're still trying to claim that they're out from underneath
They're not.
the credit Swiss exposure. Bullshit.
Yeah. Not
There's
even,
a reason why they left the U.S. and went back to Switzerland. It's out of our jurisdiction again.
absolutely. That's what makes this funny. But Matt and I will be around. We'll be here to answer all you guys' questions. I can tell you that. But I leave you all, as normal, with my good friend, Joker Ape.
Wake up with? That weakness you carry every damn day? That job you hate? That body you despise? That dream you keep burying under excuses? You chose it. Every second you let it continue, you're making the decision to stay the same. Life ain't waiting for you. The world doesn't give a damn about your sob story. It will crush you, break you, and leave you behind if you let it. You think tomorrow's gonna be different? You think change just happens? Bullshit. You make it happen. You want strength? Build it. You want success? Earn it. You want freedom? Suffer for it. There's no easy way out. No shortcut. No handout. Just you versus you every damn day. So stop lying to yourself. Stop pretending you're a victim of your own life. You're the architect. You either grab that hammer and start building something unbreakable, or you sit in the ruins of the life you refuse to change. You are not stuck. You are comfortable. And comfort is a slow poison that kills more dreams than failure ever could. So get up, get after it, and make the hard choice. Because if you don't, then stop complaining. You chose this. And if you chose this, then own it. Stop whining. Stop blaming. Stop waiting. Own the fact that every damn second you refuse to change, you're digging your own grave. One excuse, one skipped workout, one wasted hour at a time. People love to act like life is happening to them, like they're trapped. But here's the truth. You're not trapped. You're caged by your own weakness. And that cage, it ain't locked. It never was. You just got so used to sitting in it that you forgot you could break out any damn time you decide to. But that's the thing, isn't it? Most people don't want to change. They want to complain. They want to talk about how bad they have it, how life is unfair, how they wish things were different. But wishing is for the weak. Action is for the relentless. You want out? Then suffer for it. Bleed for it. Crawl if you have to. Because change isn't given, it's taken. And the price? Pain. Sacrifice. Discipline when your body screams for comfort. There's no other way. So make your choice. Stay exactly where you are and accept the regret that's coming for you. Or stand the hell up, face the fire, and burn away the version of yourself that's been holding you back. No more I can't, no more I'll do it later. Either change or admit you're choosing to stay weak. But understand this, one day time will make that choice for you. And when that day comes, you better pray you don't wake up realizing you wasted every damn opportunity to become who you were meant to be. Because when that moment comes, when the weight of every missed chance, every excuse, every wasted day slams into your chest like a freight train, there will be no rewind button, no do-overs, just the cold, brutal truth that you had the power to change and you pissed it away. And that's when reality hits the hardest. Not in the middle of your excuses, but years later, when you look in the mirror and realize you settled. You let weakness win. You let fear write your story. And now, it's too late. But right now you still have time. You still have breath in your lungs and blood in your veins. So what the hell are you waiting for? No one is coming to save you. no one is going to hand you discipline, strength, or success. You have to take it. Rip it from life's hands with your own damn effort. Wake up earlier, train harder, work longer, cut out the distractions. Kill the old version of you. The one who accepted mediocrity. The one who sat back while his dreams rotted in the graveyard of someday. Because someday is a lie. It's the word of the weak, the word of those who let time eat them alive while they wait for the perfect moment that will never come. So, this is it. Right now, the choice. Stay comfortable, stay soft, and watch your potential decay. Or suffer now, push through the pain, and forge yourself into something unstoppable. But make no mistake, what you're not changing, you are choosing. So what's it gonna be? Because this is where most people quit. Right here. They hear the truth, they feel the fire for a moment, but then they go right back to the same weak patterns. They hit snooze. They skip the workout. They talk about changing instead of actually doing it. And that's why most people never make it. They don't have the guts to suffer. But if you're still here, if you're still reading this, then there's a part of you that knows. You were made for more. You can feel it burning inside you, buried under years of comfort, doubt, and bullshit excuses. That part of you is screaming for war. It's begging you to stop settling, to stop choosing the easy road, to finally do what needs to be done. But here's the catch. Nobody can do it for you. You either move forward or you stay exactly where you are. And if you stay, understand this. You are making a choice to be less, a choice to let fear win, a choice to wake up every day knowing you are not who you could be. And that should haunt you. Because if you don't change now, then when? Next week? Next year? When you're older, weaker, and filled with regret? The time is now. It always has been. So you have two options. One, stay the same. Keep lying to yourself. Keep choosing comfort over greatness. Keep watching your life slip through your fingers. Second change. Right now, not tomorrow, not when it's convenient. Now get up, get to work. Tear yourself apart and build something stronger. But whatever you do, don't sit there pretending you don't have a choice. You do. You always have. So stop waiting, stop wishing. Make the choice that will make you unbreakable.
Nigga, I'ma go to work. 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 Still game tight, nigga. Got it from my daddy, sensitive fag niggas. Rolling in the Jag, I'm sitting in mad niggas. Still I'm talking to your boy, I'm spitting at that nigga, yeah. So tell me how you think it feel. Writing the verse in the cell, walking through the valley in the shadow of the death, still flirting with the devil whenever thinking a meal. Feeling left out, hurt and neglected, working with acceptance, I accepted. While back turned up, real reckless. I had in the time to sit it down, straight checked it. Mask up with the hoodie on the low. Plugging with Spank Boogie from the gold. This a shy lines, nigga, so get out of line, nigga. Don't be looking, don't be eyeing down me and mine, nigga, yeah. Pride comes right before the destruction. Trust this, I'm prepared for the fall. Hit a stain, hit a lane, yeah, you only live once. Then we right back to the hood, then we tear down the mall. Rob your worker for work, get back work for your worker to work. Try me, get murked with the jerk. Show the dumb jerk that the gun worked and dispersed with the merch. Then we dirt with the hearse. Nigga, I'ma go to work. Nigga, I'ma go to work. Nigga, I'ma go to work. Don't wait on me, don't think don't. That pressure, it don't leave, it sit with you. Every move you make, every step you take, you feel that way, that's what it calls. I don't rush, I don't panic, I don't move off emotion. You talk loud, but you ain't built for the pressure. I don't rush, I don't panic. I don't rush, I don't panic, I don't move off emotion. You talk loud, but you ain't built for the pressure. I go to work while you sit there stressing. You want fast, I want permanent. You burn out, I build inheritance. Every move calculated delivery. You react, I already predicted it. I don't chase no hype, I don't beg no shine. I put time on time till that shit align. You want results, but you don't want pain. That's the reason you stay the same. I go to work, I don't complain. I apply pressure again and again. You move quick, but you think too small. I move slow, but I see it out. Every step got weight behind it, every move already designed. Yeah, you chase money, I build control. You want wins, I take your soul. That pressure you try to dodge, that's the moment you fucking lost. No shortcuts, no easy lane. I take losses and turn the game. You hesitate, I execute, no extra talk. Just what I do. Every hour I put that work while you sit waiting shit to work. Nah, fuck that. I don't wait, I create that way. I don't follow, I fucking pay. You want comfort, I want growth. You want now, I want both. Go to work, no excuses, no breaks, just movement. Stay locked in, no distraction, no talking, just action. Go to work every minute, every second, stay in it. No shortcuts, no escape. You either build or you fucking break. Now you see it, what it takes, what it costs. What you risk, what you lost. You want results, but you fear that pain. That's the reason you stay the same. I don't talk, I don't explain. I apply pressure again and again. You look up, I'm already gone. Built that path, I'm already on. No applause, don't need that crowd. I stay silent, but think out loud. That discipline, that's the code, that's the way, that's the low. You either rise or fall apart. This ain't luck, this is work, this is art. Go to work, go to work, go to work, go to work. No escape, no excuses, no saving you. You either do it or you don't. And if you don't, you already know you fucking lost.
Yeah. No hook to save you. Just bars. Welcome to the cage, motherfucker. Yeah. Cage lock, we don't run, we don't break. On break. Real ones, every move high stakes. For peace, we live what we say. War zone, we all die one day. Cage lock, we don't run, we don't break. On break. No love, just the price that we pay. Cold world, better stay in your place. No play. War zone, we all die one day. Look, I don't talk tough, I just back that shit. Seen too many real ones collapse that quick. They were praying on my fall, I ain't having that shit. Now I move like a ghost where the traps all lit. Trust gone, I don't fuck with nobody. Same one smiling, wanna catch you off body. I done seen what jealousy do for a hobby. Turn a day one killer cause the money got sloppy. I don't flex, I survive, that's the code I live by. Every move low key, I don't show what I hide. You can see it in my eyes, I ain't built for the lies. If it's war, I go silent and somebody gon' die. Joker grin, but the pain still real. Every scar on my body got a name I can't heal. You ain't been where I been, you don't know how it feel. I was built in the dark, now I walk with the steel, yeah. K-Lock, we don't run, we don't break. We don't break. Real ones, every move high stakes. Fuck peace, we live what we say. War zone, we all die one day. Yeah. I don't think straight, I think better than you. Why you chasing the look? I'm ahead of the move. They say pressure make diamonds, I'm proof. Now my shine got them blind, they ain't seeing the truth. I twist words, turn a loss to a win, turn a fake to a memory, never call them again. Yeah, mind sharp, every line cut skin. You ain't built for this chaos, don't step in the den. Laugh now, yeah, the joke on you. You was sleeping on the wave, now I broke on you. I don't play fair, I expose what's true. Put your pride in the air, let the smoke run through. Bars heavy like a brick to your face. I don't miss, I just pick where I place. You predictable, stuck in your ways. I'm a glitch in the game, you erased in the day. K-Lock, we don't run, we don't break. No love, just the price that we pay. cold world, better stay on play. No play. War zone, we all die one day.
Yeah. I don't calm down, I explode when it's time. Too much rage built up in my mind. They was testing my patience, now they crossing the line. Now it's war every time that I step in the rhyme. I remember nights I was broke, no light. Now I walk through the fire like I'm built for the fight. They don't know what it costs just to stand this height. Every scar got a story, every wrong made right. I don't forgive, I remember that shit. Every fake, every snake, every move counterfeit. Now I'm cutting them off, I ain't dealing with shit. If you cross that line, you get buried with it. I don't rap for the fame, I release what I feel. Every line like a shot, yeah, this shit too real. You can hear it in my voice, I don't fake, I don't chill. Crazy anger turn power, now I move with a will.
Ain't no heroes in this shit, just survivors. Bodies they don't talk about. Hey, K-Lock, we don't run, we don't break. We don't break. Real ones, every move high stakes. Fuck peace, we live what we say. We say. War zone, we all die one day. Yeah. Welcome to the cage. Ain't no way out.